ahead of us, and we want to make the most of it. I'm Marshall Bhutan. I have the privilege of chairing the International Advisory Board of the Center for the Advanced Study of India at the University of Pennsylvania. That's a mouthful. CASI, I think known to many of you as its short name. We are really delighted to have Dr. Reddy, Dr. Y. Venugopal Reddy here to speak to us this evening for the 2009 annual lecture of CASI. Dr. Reddy will be introduced to you shortly by Rajiv Shobti, but I would like to make a few comments, in particular because I know there are a number of people in the room who are not as familiar with CASI as perhaps others are, and it's important that I think you do have some familiarity with this very unusual organization. Let me say that, and this is my judgment for what it's worth, but I think fairly said that the Center for the Advanced Study of India is a unique resource in the United States. It is the only university-based education and research organization devoted to the study of contemporary India, in particular India's contemporary political economy. It draws on the strength of a great university, the University of Pennsylvania, but it does so in a way that relates outward to those of us who are interested in current developments in India in a broad context. The University of Pennsylvania, as many of you know, is one of the great centers for the study of India and has been so for the last 60 years. CASI was started by Francine Frankel, whom we all know, a great vision she had now 15 years ago to create this Center for the Advanced Study of India. And it has occupied this very important place. It does carry out academic research, organize conferences, sponsor fellows, produce publications, all of which are of the highest scholarly caliber, but all of which are also framed in terms of their relevance to what is happening in India today, and just as importantly, what is going to happen in the future. Now, we all know that in the last decade especially, the India brand has appeared on the screens of many more Americans than were earlier focused on India, other than for reasons of cultural interest or tourism. But CASI preceded that development, and it has established a very important reach and reputation and relevance that it has been growing under Devesh Kapoor's leadership in recent years, and I am confident will continue to grow. I want to add that CASI is not only a resource for the scholarly community broadly in the United States and overseas, and in India for that matter, but it is also a great resource for Penn students and non-South Asia focused faculty. The center provides internships and summer fellowship opportunities for Penn undergraduates. It provides opportunities for graduate students to work on issues in the course of their graduate study that are of interest to them related to India's contemporary political economy. It also brings fellows and other visitors from India to the Penn campus and makes them available, makes it available to them for their own research and writing, but also makes them available to the Penn community. And Devesh has expanded that circle of CASI's activity in the short time, only 3 years since his arrival, to include many of the other professional schools and the key departments of the university. And last but not least, CASI has maintained a quality of effort and autonomy and a scholarly integrity amidst its focus on the contemporary issues in India, that allows it to look beyond today's headlines and beyond conventional wisdom. There is, even now, in our more recent discovery of India, a certain faddishness from time to time as to where Americans look, what they seek to, what they perceive about India, what they think is important about India. And yet, as many of you know from your own personal and professional experiences, it's a far more complicated picture than that. But to bring that understanding that scholars are able to develop and articulate to a broader audience is the special opportunity and the special responsibility of Cassie, one that it has been carrying out very, very well. Devesh Kapoor has taken Cassie to very exciting new levels of visibility and impact in the scope of what he has undertaken to do, in the intensity of what he is doing, and frankly in the imagination of his vision for what Cassie could become. So all of us who are interested in India and interested in its today and its future are fortunate to have Devesh at the helm of the center. We are going to try to do more activities under Cassie's wing here in New York in the years to come, but we could not start on a better occasion than this evening with Dr. Reddy. And now I'd like to ask Rajiv Shopti to introduce Dr. Reddy.
Good evening, everybody, and welcome to the Jeet and Nand Khemka Distinguished Lecture Series. It's my privilege to introduce this year's speaker who will provide the address, Dr. Venugopal Reddy, an individual who does not need any introduction. It makes my job a lot easier. So I will just highlight a couple of biographical points to highlight his contribution in the field of economic policy and academic thought at various points in his life. Most recently, he retired as governor for RBI, Reserve Bank of India, in 2008. And over the 5 years, it's fair to say that he oversaw a transformational period in the Indian economy. And in fact, in October 2006, was recognized as one of the 5 original reformers for the Indian economy, along with Dr. Manmohan Singh, Mr. Chidambaran, Dr. Ahluwalia, and one of my former faculty members from Ahmedabad, Dr. Rangarajan, who a lot of us will know. So clearly he has been very well recognized for everything that he has done. He has served at the World Bank and IMF, and currently is a professor emeritus at the Hyderabad University. Today's address, I think, will serve as a valuable roadmap for policymakers all over the world, not just in, of course, the basis is the Indian experience, but I think it will serve as a very important and valuable roadmap all over the world. And Dr. Reddy has kindly agreed to take some questions at the end of his comments and the end of his address, and Devesh will serve as the moderator for that question and answer session. And with that, let me once again thank Dr. Reddy for being here and welcome him to the address. Dr. Reddy.
Respected Mr. Marshall Boughton, Mr. Sopti, Dr. Devesh Kapoor, and distinguished guests, I am thankful to the Center for Advanced Study of India, University of Pennsylvania, for inviting me to deliver the annual lecture of the Center in New York. It is indeed a great honor. At the outset, I would like to thank the organizers for the very warm hospitality and courtesies extended to me by all, in particular Dr. Devesh Kapoor and Ms. Tanya Kerr. There are many experts and scholars here on a variety of subjects, and in particular in areas of finance and money. Therefore, I am approaching the subject with a degree of humility. So what all I can do now is just to share with you what could be my insights on the experience of financial sector regulation in India. It was considered unorthodox in the past, but many of the issues that cropped up during the regulation are now coming back into a discussion. Incidentally, when I was being introduced, it was said that Dr. Reddy needs no introduction. That's the standard opening line. But the standard unsaid line is, he needs only a conclusion. Because very often the financial markets used to say that I'm not very clear and transparent. I said I must confess that I'm very transparent in conveying my confusion, because the reality is complex. But one thing I would like to make it clear at the outset, that in the last 5 years, actually the monetary and financial policies in India were very active. They're action-packed. And that, if you have a slightly broader view, rather than the capital account convertibility and the limited cross-border issues, you would be able to appreciate. And I would mention a few of them now. Considering the enlightened audience, I will be concise and will elaborate if required during the questions and answers that is to follow. While being selective in coverage, I will certainly keep in view the major themes that are being considered in the ongoing global debates on the subject. In particular, we have Stiglitz Commission of the United Nations, the Warwick Commission report, which is likely to be released in a couple of weeks, the G30 report chaired by Paul Volcker, Turner report chaired by Chairman of FSA, the G20 Working Group report, Mr. Delarosier's report on EU, and more recent proposals in UK, USA. You have been reading papers in the last couple of days. So I think there are a lot of debates going on about what are the important issues in financial regulation. And since there is no agreement among them, surely I don't expect that there will be agreement about what we did in India either. So we don't have an agreement on what is to be done. Therefore, we can't expect that there will be an agreement on what has been done. But I think it's better to see what has been done in different countries. Again, we have to be very clear that in a highly evolved market conditions, highly evolved financial markets like USA, which is different from, say, Japan, which is different from Europe, which is different from India, in spite of the global finance that has a large impact, but we cannot afford to ignore the differences. And my own impression is that the differences will come to light as we go forward. My presentation today is divided into 3 parts. The first part is macro issues. Basically, I think one of the things which is coming to light, but which has not been perhaps fully explained or appreciated in the popular debates, is that the current global financial crisis is not entirely a crisis of financial sector or financial regulation. It has a lot to do with a lot of the issues of macro and monetary issues. So I will cover that part and put it in the perspective, and then move on to a description of our experience with regulation of financial sector, and perhaps a brief account, very brief account of way forward. Macro framework. First, the major approach of India has been to avoid serious imbalances. Whenever you see the debate about global economic imbalances, excess savings, excess consumption, India is not there in that issue of imbalances. Imbalance between saving and investment, consumption and investment demand, dependence on domestic or external demand, sustainable current account deficit, which has led many countries have gone to IMF because of that. All this, it was a deliberate policy, a consensus of public policy that we should avoid serious imbalances. These trends are very important for India in view of its vulnerability from 4 important sources of shocks. First and most important source of shock is fuel, the oil price. It can vary, and we are very much dependent on imported fuel, which creates a huge impact on the whole management of the economy, in particular balance of payments. Second, there is food shock. We are broadly self-sufficient, but whenever there is a deficiency, the deficiency may be small in relation to India's supply-demand position, but its impact on the global market is huge, and the prices are driven up. So we are vulnerable to, whether it's drought, so we are vulnerable to shock on account of fuel, on account of food. Both of them are essentially current account shocks. We have a fiscal problem with a debt GDP ratio of over 70%, 80% now. And we also have an external finance problem. The external finance problem essentially is in the nature of what I may call the quality of the capital flows. It's not only the quantity, but the quality. And as it's known after the Asian crisis, one looks at the stability of the flows. So India is perhaps one of the countries where there is maximum dependence on portfolio flows. And the numbers with regard to foreign direct investment should be taken with some understanding of the difference between investments in greenfield and those which are not in greenfield. Those which are not in greenfield essentially amounts to transfer of financial resources. And if already there is a capital account surplus, it is mainly adding to the surplus of the capital account. And so this distinction will make it clear in terms of its impact on real economy. Second, on monetary policy, just as macroeconomic framework avoids imbalances, monetary policy is characterized by pragmatism and being proactive. First, objectives. The objectives are not explicit, it's very vague in the Act. In fact, I must tell you that 1935, when the Reserve Bank of India Act was passed, the preamble said that in view of the very difficult and uncertain global conditions, as a temporary arrangement we are passing this law. It's continuing till today. And you will be interested to see the preamble. And it's reinforced, the uncertainty has been reinforced more recently, and this is the 75th year of the founding of the Reserve Bank. However, the Reserve Bank, but by implication, and this was articulated by Dr. Rangarajan, it's the twin objectives of maintaining output growth, output and employment, and the price stability. It's not single objective of price stability. But in the last 4 or 5 years, we, in the Reserve Bank, announced a self-imposed objective of keeping prices below 5%. And over a medium term to 3%, because over a medium term, your inflation has to be broadly in alignment with the global inflation if you want to have a full global integration. A persistent inflationary difference could be quite disruptive. So this was how it was articulated by the Reserve Bank. It was not a target in that sense. Second, the Reserve Bank announced about 5 or 6 years ago that financial stability is a specific objective, but it is, in a way, it is explicit now. But we cannot think of output and price stability without financial stability. Financial instability transmits itself automatically into output and or price stability. But this was articulated by the Reserve Bank of India as a self-declared objective. There was no waiting for any mandate. Given the developments in the financial sector, therefore, this came up. But more important, in its articulation, the Reserve Bank made it clear that the weight for financial and price stability has to be more in India. When you take the relative weights between growth and stability, It is true growth is important, but when you have large number of population, large people who are poor, who don't have hedges, who don't have social security, then what's the problem? The problem is that growth trickles to the poor. The stability impacts immediately. Instability impacts immediately. And particularly if you're in the reform process, the reform process is sustained if there is an assured growth without instability. The popular support for reform itself will be undermined if there is one serious event of instability. And therefore, we went on emphasizing that at this stage of structural reform of the economy, to maintain the public support, we have to give a higher weight to price and financial stability whenever we are evaluating the risks. So policy was inevitably, it became counter-cyclical because you wanted to moderate the booms and busts. In fact, in 2002, 2003, there was a criticism that we are having a lazy banking. And then some actions were taken, it became crazy banking. But both lazy and crazy banking did not result in serious instability. That is the management of the policy. Not that you eliminate, but you make it acceptable. Another aspect was that while doing the counter-cyclical policy, the dominance of the domestic economy was kept in view. In fact, for the first time, at least since independence in India, the word of early signs of overheating was used in the monetary policy. When you are growing at 9%, and if you don't have roads, if you don't have ports, if you don't have power, it's clear for everybody to see that there are supply rigidities and there are early signs of overheating. And of course, after using the word once, I was persuaded not to use the word, but I continued to use the policy as I liked. The second is, no formal persuasion. But the second is that the multiple indicators, generally the indicators are very clearly supposed to be the rule-based. But in our situation, we had to look at a number of indicators. Part of the reason is that the burden of the counter-cyclical measure is more on monetary and financial sector policies if the fiscal headroom is less. If the fiscal deficit is already high, if there is a strong component of structural fiscal deficit, then the maneuverability for the fiscal policy to manage the cyclical features is less. So that also we have to take into account. And second, which is sort of unsaid, is that at that stage of development in India, and for the first time we have seen a growth which is respectable everywhere, so there is a huge political commitment to see that it is not derailed. So for heaven's sake, don't do anything. We can't take the risk. Never since independence or before we had this rate of growth. There is almost a fear that you are risking a growth politically, and naturally the time horizon is different. And the financial markets also have somewhat similar, if not shorter horizon. And if both reinforce each other, the life for a regulator or monetary authority is not easy. Apart from so in the multiple indicators, one of the things which we are tracking was the credit growth. When the credit is expanding too fast, and if you see the loan-to-value ratio, you could easily find signs that people were betting on the prices increasing in future, especially asset prices. These indicators were very clear. So the issue was whether we should expect the markets to correct or we should do something about it. So the issue is, if you allow the markets to correct, in the financial markets it may be smooth, but in the real sector, where it will affect, it is not smooth. You get bankrupt if you don't get export orders for 3 months. After you get bankrupt, you can't get unbankrupt. You can't start a factory again in 3 months. So that type of adjustment, the type of adjustment which the financial markets believe happens, and it may happen in financial markets, it happens in financial markets. But there is a corresponding real sector. In the real sector, there is adjustment of costs. The bones are broken. They are never fixed properly. In the real sector, that's the real life. And therefore, we had to take into account this whole issue of credit growth and the need to look at these asset prices rather than expect that it may correct itself, but how painless it will be, what will be the cost. The other is the multiple instruments. In a complex situation, the whole theory that there is single objective, single instrument, and there is very efficiently delivered, it is good, but unfortunately, the reality is a lot more complex. Both, particularly in the type of institutional context in India at that time, but now perhaps other countries also recognize the institutional complexities. So it is not only direct or indirect instruments, we had to use both. And especially due to excess capital flows with the globalization of finance, we had serious problems. But again, fortunately, we anticipated them even in 2004. We projected and said, okay, we should be prepared if these capital flows come. So for that, we had a range of instruments. One is the liquidity adjustment facility. Basically, what it does is virtually every day, the Reserve Bank is prepared to take the money in, if need be, is prepared to take the money out, and there's a corridor. And they operate through the banking system. So that type of stability is maintained. And we can always do, just as if there is uncertainty in the markets, the spread increases. The Reserve Bank also increases the spread to show that there is uncertainty, and let it sort it out. So this was introduced. Second, this is another interesting thing. We introduced a concept called market stabilization scheme. As you know, when there is excess capital flows, you can allow the exchange rate to appreciate, but that's a question of how far. That's another thing I'll cover when we come to the issue of external sector. But once you intervene, you have to sterilize. If you sterilize, then there's a cost of sterilization. You are taking the money out of the system, and you can't use it. You have to pay interest on that. So we went and told the government that, look, there's a sterilization cost. If you want me to incur, I may incur the cost, but that's my discretion. But ultimately, it goes to the government. It's a fiscal cost. It has to come out of the government budget, especially given the magnitude. It is not small. And we expected that it will be huge and over a longer period. So we went, and I must share this with you, that when we went to the government and said that, look, you tell us how much I can issue bonds on behalf of the government with an assurance that that money will not be used. They issue bonds, they take away the liquidity, and it's just kept there with us. It can't be used. And then we will release it if there is a reversal of the capital flows. So you give the rupee liquidity, and then the dollars can purchase. So that's the system. I must tell you that in the ministry, there is an opposition to this proposal. One, it is unprecedented in the world. Second, they said it affects the independence of the central bank. Exchange rate has to be managed by the central bank, and you must have independence to decide what you want to do. So I said, I don't want independence because it's too expensive. The people of India have to pay for this. And it's only the government which can take a view on how much the people of India should pay for the combined excess capital inflows and the desire to maintain a particular exchange rate. These are the two issues. And they are too important to be left to an independent central bank. And I'm glad the political authorities agreed with me. So every time a ceiling is fixed, and then it keeps going up and down. So that's how the cost was transparent. Third, we also had to impose a burden on the banking system through cash reserve ratios. And one of the things, again, we did was if the cash reserve ratio, you must make the banks to put the money with the Reserve Bank, there is to be remunerated. Now, if you are remunerating the banks with regard to the cash reserve ratio, all you are doing is there is no pain. You are only sucking some liquidity in. But if you really want it to be effective, then it should not be remunerated. It should not be remunerated. So we would manage to get a law passed in the parliament that if the reserves are imposed, if the cash reserve ratio, if they are imposed, no remuneration shall be paid by the Reserve Bank of India. You would agree that banking industry was not very happy with that, but it has served as well. And the whole set of instruments has also a time dimension, distribution of burden, which is mutually agreed. Now let me come to the fiscal policy. It's already 6:40. I'm sorry. In fiscal policy, as you know, we have high public debt. We have continuing fiscal deficit. There are also informal items. And the issue of quality of fiscal deficit also is important. Technically, if you have fiscal deficit, if you invest in infrastructure, if you invest in productive avocation, certainly it is good. But if it's going for revenue deficit or subsidies, then you don't know. All I can say is we don't know. But what happens is when there's such a large fiscal deficit, we are talking of 8%, 7%, but fortunately during these 5 years, the fiscal deficit came down to 5%. From about 8 or 9, now it has gone back, but it's a part of the stimulus. The more important thing is we're able to bring about the FRBM, Fiscal Responsibility and Budget Management Bill, basically to make a commitment to bring the fiscal, bring transparency to the budget and manage the fiscal situation. But the fact remains, with large public debt and with the type of fiscal deficit, which is more or less given as far as the government is concerned, once its budgets, it will do the borrowing program. It's not interest rate sensitive in some senses. It has to do that. In which case, the burden of ensuring stability falls on the Reserve Bank. The burden of ensuring that the borrowing program goes smoothly is on the Reserve Bank. If it doesn't go smoothly, that's the benchmark interest rate. That's the benchmark for corporate debt market, for everything. So the huge fiscal hangover. But I must mention here something interesting provision which we did for FRBM. We did in the Reserve Bank did the technical work at the request of the government. We have an emergency provision there. Now, we avoided earlier. We used to have an automatic monetization. Whenever the government wants money, we have to produce it, or that a central bank could participate in the primary markets. But we introduced a provision saying that in case of extraordinary situations, the Reserve Bank may directly contribute to the government's borrowing program. Now, let me give you, I don't know how far it is applicable. Imagine, for instance, in USA, the central bank is providing money at 0.5% or whatever it is, and then the government has to borrow at 3.5%. So you have a clear 3%. The central bank is giving money to the financial markets who are intermediate and giving it 3.5%, which is correct in the normal circumstance. But if you accepted that the whole market mechanism has broken down and that the government is giving a huge bailout program, that's a situation where you don't use the same sort of not so normal markets to intermediate. So far better would have been for the central bank. At least in USA it may not be possible, but we wanted to have that in India, and we have that provision. In fact, almost all legislations, we made a provision because we don't know. Everywhere there is a provision which says that in extraordinary, for instance, capital account, in extraordinary, even current account, in extraordinary circumstances. And the law says extraordinary, and therefore they have to defend before the parliament what is extraordinary. But that the public policy has several instruments at its command. And to be able to intervene with some sense of accountability when it is necessary was one of the basic principles of the reform. And as you know, a public policy instrument is a constraint on the market. And the freedom of the market is a constraint on the policy. So this is the balance that we have to keep. But the difference is what's the normal time, what's an extraordinary time. That, I would say, is the innovation in Indian public policy. Another aspect is with regard to, that's what I was reading in the papers today, or yesterday, about the state governments. In India, the debt of the state governments also is managed by the Reserve Bank of India, not only the debt of the central governments. And the Reserve Bank of India is also the banker to the state governments. The state governments cannot borrow in foreign currency. With the result, it has been possible, despite of popular pressures, for the Reserve Bank, which, unlike the government of India, which may be identified with different political parties, it has a certain amount of neutrality about it. And therefore, we have been able to maintain, by and large, a fairly reasonable stability in the state finances. External sector. The external sector, as I mentioned, the Foreign Exchange Management Act, the current account is free, except in extraordinary circumstances, but capital account is managed. That's how the new legislation comes up. But the most important consideration in the management of the external account is a sustainable current account deficit over the medium term. That means over the medium term, the current account deficit should be such that the capital flows will normally meet the current account deficit over the medium term. So the question is, if you incur 6%, people say that we must have got more and more foreign investment. Basically, the more foreign investment comes in, and you can observe, only if the current account deficit is high. Now, if somebody says infrastructure is required $500 billion, okay, $500 billion is about 50% or 40% of the GDP. If you're going to get only for infrastructure in the next 4 years, then your current account deficit should be 10%. And whether the rest of the world will be prepared to finance 10% of the current account deficit. So this is the type of situation when you look at macro. And we have always been insisting, thanks to Dr. Rangarajan's committee, of which I was the member secretary, we said you must make a judgment, but the current account deficit should be sustainable by normal capital flows. Which again means that, of course, there's two different things, the manufacturing and non-manufacturing. And in the manufacturing, as you know, as jocularly mentioned to somebody, India has outsourced the manufacturing industry because our trade deficit is 78%. So the manufacturing has been outsourced and the services has been insourced. But that, whether that's good or not in the longer run is a bigger issue in terms of the employment. But this has a relationship with the exchange rate. In this connection, we introduced a concept for analytical purpose, not for sustainability, but for analytical purpose, adjusted current account deficit. The adjusted current account deficit removes the NRI remittances. Remittances is like your brother-in-law or brother sending money. That does not reflect the strength of this domestic, of the household, or the domestic economy. But it's able to manage today, but it does not reflect the strength. Therefore, we take it out. And if you take the adjusted current account deficit, that has relationship with the exchange rate and its impact on the economy. And so this is one other thing which we introduced analytically within the Reserve Bank. And as far as the liberalizing the external flows are concerned, in fact, in the last 4 or 5 years back, we introduced this. The corporates, basically we made a distinction between households, corporates, and financial intermediaries. As far as households are concerned, the major issue was that the markets, the flexible exchange rate, etc., should not only be among the markets, but should be in the minds of people. And that comes when there's a two-way movement. And that two-way movement had to be induced for some time. And that has been settled. And definitely we can say 2004, 2005, 2006, there has been a two-way movement. So the people don't hold on to dollars somehow or other today. So therefore, we're able to liberalize the household outflows also. In the case of corporates, there is an underlying real economic activity. Once there is an underlying real economic activity, then you don't have a multiplier problem, you don't have a leverage problem. That's why you will find in the last 4 or 5 years, many corporates went, borrowed, took over the companies. But when it comes to financial intermediaries, there is a problem. Financial intermediaries, A, they are leveraged. B, the relationship with the real activity is not very clear. And C, and most important, the currency mismatches are introduced. And therefore, you do not know what is the border, what is the differentiation between prudential regulation and capital controls. So therefore, it was the financial sector which was subjected to significant constraints. And that you would have seen from the basic pressure for capital account liberalization is from the financial sector. On the exchange rate, it is managed exchange rate, not technically, not formally, but there is significant intervention. I won't say technically managed, but basically no volatility. When we started the policy when Dr. Bimal Jalan's time, they said corner solutions are right and what we are trying to do. But now, of course, the main wisdom has come back to this, that you should fight volatility. And there's no fixed rate in view, though we have to keep in view the harmonization with fundamentals. So some time back, somebody asked me when I was governor, they said, what is excess volatility? So do you mean to say that the current exchange rate is right or wrong? And how do you intervene if you can't say what is right or wrong? So I said, I'm sorry, I cannot define God, but I can recognize devil and I'll fight it when I see it. Now coming to the real sector, the major emphasis, the point was that the real sector should be marketized significantly because the financial sector is supposed to allocate resources in the real sector. If the real sector markets are distorted, if there is restrictions on trade, if there are controls, etc., then the financial sector also will misallocate the resources. That's the only way in which the financial sector can make money. So in a way, therefore, there should be harmonization between the extent of reform in the real sector and the extent of reform in the financial sector. The idea that the financial sector by itself will stimulate the real sector competition, real sector efficiency, that is questionable beyond a point. Up to a point, it can happen. So that was the basic, and you have the restrictions on agriculture, restrictions on commodity movement, especially important commodities, and also rigidities in infrastructure. So, in fact, in India, a lot of financial sector is used to administer development. 25% of banks' deposits should be invested in government securities, 40% in priority sector. Then what is left for banking? And much of it is on the prescribed interest rate. Now, if this is the overall policy framework, and to imagine that we have to marketize everything, then we're going to create problems. So we have to recognize the requirement of balancing the variety of considerations. Now I come to the financial sector. I'll take 7 minutes, I'm sorry. I'm exceeding my time. But I'll be brief here. I think two things which we had most important in financial sector is precautionary and developmental. As I mentioned, because the stake in instability, etc., we want to be precautionary so that instability does not derail development. Second, see how development happens. And development is not merely accumulation of capital, but on a variety of fronts. And what are the first thing which we had to do in 2003, about 5 years ago, when we started in one phase of reform, is there shall be no weak bank. First formulation. Reform starts when there is not a single weak link. And eliminating weak banks is not exactly a pleasant task. And that's how my life started in the Reserve Bank as governor. And again, first in the commercial banks, there's a high-profile bank. It's not a large bank, a high-profile bank with all modern instruments and technology, systemically important. But it had a lot of holes in its balance sheet. And therefore, first thing is, and it was not only systemically important, but politically sensitive bank. But that was the best way to start. And that was what was closed, merged. Some notice was given. It was done over the weekend, Friday. At that point of time, the whole world fell on us that we are non-transparent, we did over the weekend. I was happy to see that many things are done over the weekend now. And we didn't inject any money. No money, it was merger, and it was all done over the weekend. Next. And it was questioned up to Supreme Court, we won the case. Incidentally, I must tell you that in another case, the number of banks, either we merged or we closed. In one particular case, the banks, the ownership went to the court and they said that these people prepared, the government has to pass the order. So these people, they said that they prepared the order in advance because it is dated so-and-so, and it couldn't have come through post, it couldn't have come, the original can't come and could be delivered. And no officer of the Reserve Bank of India traveled by any of the aircraft. They got all the names of the aircraft. But what they didn't know was there was an Air India international flight at 12:30. That's where my officer took the flight. And this is fact, and this is what we did. We had to do that, otherwise it would have leaked out. They're expecting something like that. Anyway, so it's not only the weekend, but midnight also is important in dealing with banks. Now, the also urban cooperative banks. We had our serious urban cooperative banks, and the law could not be passed with regard to the dual jurisdiction, urban cooperative banks jurisdiction of the state and the Reserve Bank. We had a big problem. Finally, we decided that we will not issue a new branch license, etc., etc. Severe actions. And if you recall, the Ketan Park scam of 2001 was essentially to Madhapura cooperative banks. So we got into individual agreements with individual state governments. If you get into an agreement, if we agree, then I'll give you a branch, otherwise no branch. And we closed down a large number of urban cooperative banks before they became systemically important. So the second cleaning up. Third, regional rural banks. These are not known here, but those are the banks which affect maximum number of people. And they had to be recapitalized. And some of them had to be merged. The rural cooperative sector, it had to be caught. So all this cleaning up had to be done so that there is no weakness in the banking system. You have to eliminate the weakness. That's the first step towards any reform. Next, Counter-cyclical. We adopted a policy of counter-cyclical policy in financial sector, which is now very, very much in the discussions. Why? Our logic was fairly simple, apart from the importance to stability. When does the risk arise? A risk does not arise after it becomes a non-performing asset. A risk arises basically when you extend the loan. And therefore, we said you watch the credit growth. And whenever there is a credit growth in some sectors, you watch. That's the time when the risk is being generated. And that's the time when you have to start assessing how the risks are being generated. That's the first. So credit growth sector-wise. And the loan-to-value ratio, that's the monitoring. Second, risk is not necessarily unidimensional. It's not only non-profit liquidity. Many dimensional risks are there. Three, risk could vary as between different sectors, as I mentioned. And risk is difficult to assess in a country where there is a significant structural transformation that is happening, the huge structural transformation. Then risk is complex if markets are illiquid. Your houses were, just to transfer a house, you have to pay a duty of 12% in most of the places, apart from all other aspects of tenancy law. So then you have this, how liquid are the real markets? And those risks will fall on the financial sector. So basically, and we have said that the risk has in banking system has serious consequences. That's where the precautionary motive comes in. And therefore, we used all the instruments, capital adequacy, risk weights, provisioning. In 2002, we asked for creation of investment fluctuation reserve. Then we prescribed limits up to which you can invest in risky assets, because basically the idea was that the bank has, let me go back, universal banking was acceptable, but universal banking in a constrained sense. The retail banking has to be the main core, and universal banking in a constrained universal. That has been the approach. And people argued that we don't have a formula-based approach for the counter-cyclical policy, but I said we cannot afford to wait for formula. We have to do something when there is a problem. But in basically, we had both general and selective instruments. Capital adequacy, again, counter-cyclical is one part. This is another area which is now discussed. Off-balance sheet items, we have been very particular about monitoring off-balance sheet items of individual banks, and we believed on identifying where the growth is. And another thing is credit conversion factor. In creating a credit conversion factor of an off-balance sheet item, we have been very conservative. Accepting. The another thing is you have a situation in many banks under the new provisions that even a borrowed money is treated as capital. We're a tier 1, tier 2, tier 3. So we were also adopted, but with a little more caution. The argument that regulation are burdensome for, and I try to explain, how can it be burdensome if the share market of the banks are increasing, share prices are increasing manifold year after year? So obviously the regulation is not burdensome. And so whatever the indicators you take, so you can't say that there's an excess burden except an exception. Banks and other, in terms of the scope, another issue has come that the investment banks were not. So the approach there was that in particular banks, all deposit-taking institutions, and all systemically important non-banking financial companies were monitored and regulated, and their leverage was prescribed. I must again tell you a story here. In 2004, by then there was a proposal before the Reserve Bank of India, before the government, to amend the law, removing the powers of the Reserve Bank to regulate non-deposit-taking institutions on the ground that they are non-deposit-taking and they are intrusive. I met the finance minister, Chidambaram, and I explained to him, it's not that we want to use, but we want to monitor the systemically important non-banking financial companies. And if it's required, we should have the power to regulate. So don't carry through the proposal that was sent by us before. And he said, how did the people anticipate? There already pressure for me to pass an ordinance. But fortunately, he didn't do that. And we are in a position to monitor and take some corrective actions, not too much, but some corrective action, I believe. Then there's another issue which is coming up is the competition, ownership, and governance. And there you have the CEO's remuneration. As far as the banks are concerned, the CEO's remuneration has to be approved by the Reserve Bank of India under the law. And we generally have, to my knowledge, not approved either signing in bonus or signing out bonus. So you have just the salary and some shares which you can take. The basic issue is there's a public sector banks and some private sector banks. The regulation is absolutely common. Regulation is common, but private sector is a little more innovative in minimizing the burden of regulation, if I may put it politely. But the governance side, on the governance side, the governance of the private sector is with the Central Reserve Bank, but the governance of the public sector is with the government. So we only take up the matters with the government, but by and large, in terms of regulatory standards, I should say that we have absolutely no interference, have never been there. Consolidation is another one, too big to fail. The issue has come. The Reserve Bank's view has always been, though the government was somewhat inclined towards consolidation, big is better, the Reserve Bank's view was consolidation in terms of improving the health, not necessarily mergers and acquisitions. That has been what it is. In brief, banks were treated as a sort of a public utility. It's just not a market mechanism. They are licensed. They are essential for the life of the community. It's like a power, like water. You require payment system. You require some place where people have to keep their money, especially poor people. In India, for most of the people, especially women in the villages, they don't want loans. They want a place to keep the money safe from their husbands. That's the basic issue, and that's what we have to provide. And that is why, again, we went into the whole issue of financial inclusion. It's not the credit pushing that's important. It's financial inclusion. And that's the emphasis. And financial innovations, again, we linked it to the underlying transactions. I want to do much. On consumer protection, again, under the new system, you have this Product Safety Commission. We have a slightly different version. We have introduced ombudsman. We have introduced the standards and boards where, like the UK model, the banks themselves indicate. The main problem is very often some banks say, these are our standards, but only nobody knows whether the standards announced have been followed. So you'll find an advertisement, SMEs we serve. So how much they serve, there's nobody who is able to say. This is the service we provide. So this is a voluntary body promoted by RBI, but with the IBA, so who evaluate the services with reference to the standards laid by the bank itself. So these are the type of innovations we have done. Finally, on the regulatory structure, which is again a lot of debate in the USA also, the stand that has been taken is that the view is that coordination is important, whether it's multiple or single. You can have single but different departments quarreling. You can have multiple different regulators cooperating. The coordination is important. And we have a standing mechanism, a high-level committee on financial markets presided over by the governor with all the regulators and the finance ministry. This has been working fairly well. And now there is a proposal to make it legally binding. But it was quite good when it was not legally binding also. But let's see. On way forward, there are several challenges, I believe, on way forward. One, financial inclusion. Not many people are included. Second, customer service and protection. Third, credit penetration. Fourth, credit culture. In India, generally, people repay loan to bank out of moral compulsion. There's no legal necessity at all. So it's that type of situation. And but it doesn't mean that we have no vulnerabilities. If you go back, if you go to the fundamentals, what we have said is the super surface. Fundamentals, there are 3 or 4 basic issues which I believe we'll have to consider. One, is there appropriateness of incentives in the financial sector? In India, in the mutual funds, which are meant for basically individuals, the mutual funds are the whole concept is that the individuals who come together and ask somebody else to manage them. A major part is by the corporates and the banks. So the incentive is to serve the interests of the corporation and the banks, who account for 70%. So this is one issue, which is, I think there's a realization about that. Second is the conflicts of interest, particularly between mutual funds, non-banking financial companies, and corporates who promote them, and apart from some banks also. There is excessive financialization. To give an example, you will find a refinancing body, it will issue the bonds. The bonds will be subscribed by the bank. Then the refinancing body takes the money from the banks through the bonds guaranteed by the government. And then the refinancing body will refinance the banks up to 70%. So it's just multiplication of the financial transactions. And there is understandably interest in the financial sector for multiple transactions, because that's where the margins are. So this has to be taken care of. Then irresponsible lending, like subprime, we may have our own subprime, mainly through the for-profit microfinance institutions. Conclusion, there is a new consensus, I believe, on issues relevant for financial sector regulation and related macro aspects. The consensus is not on the solution, but there is a consensus on what are the issues. But both regulation of finance and perhaps there should be re-regulation of finance in some senses, but also recalibration of global finance. For India, financial and external sectors, way forward, caution is extremely important because there are a lot of uncertainties in the world, in the financial world. Caution is extremely important. But there are some sectors where urgent action is needed. These relate to real sector, infrastructure, and fiscal sector. Thank you very much. I apologize for exceeding my time.
Thank you to Dr. Reddy. I think the passion and the integrity with which he took his job is so self-evident in his talk. You'll take a few questions? Yeah. Hey, anyone? Yes. Where's the mic?
Dr. Reddy, the central bank in India recently made a big purchase of gold, and it seems other central banks around the world are going to follow suit. What is your take of that decision? What are the factors leading to that decision, and what does it imply for the global outlook?
I think my views on economic policy should be basically history. But I can give you, as an academic now, in my hat as an academic, as a general principle, when you have the reserves, as you know, the forex reserves have two components, foreign currency and gold, and sometimes silver. So it is a recognized component of the forex reserves. Second, how much should you hold? One, if everything else is the same, you have a particular percentage of your forex reserves as gold. That percentage has fallen for India because the reserves have grown. So in the normal course, you have to increase that. Third, over a period. Third, given the sensitivities of gold and gold market, ideally, a central bank should be able to buy it from a public institution, and IMF is a public institution. And therefore, there is no issue in terms of market disturbance. The market interpretation is different. But from India's point of view, academically, it is logical because the percentage has become too low. Second, the window of opportunity, irrespective of the market conditions, is ideal if there is another public institution, because it's a transaction between two public institutions, and therefore, both from a global point of view and India's point of view, it is least market distortionary. If still the markets make the interpretation, that's an independent matter.
Thank you. Yes, here. Yeah.
So Dr. Reddy, you highlighted the importance of price stability as a policy imperative, and in that context, what are your views on a strong rupee versus a weak rupee? Because from time to time there are all these tactical pressures from exporters and the software sector and whatnot in terms of a weaker rupee or managing the rupee. And what's kind of your view, say medium to long term, on how the rupee should be managed?
Again, as I said, I can't define God. But there's no devil around at the moment. So.
Yeah.
Dr. Reddy, during the financial meltdown in US and Europe, you navigated the system very well, and congratulations to you on that. So I'm going to move away from the Reserve Bank scene, and I was at a seminar at Columbia University yesterday, and two well-acknowledged professors were telling the audience, which concluded about 100 people, and the subject of discussion was ending poverty in the world, and India was cited as an example along with African countries. The conclusion by these two authors were the only way to end the poverty in India is economic growth. So, whether it happens or, in the metropolitan areas, villages, the economic growth, 7%, 8%, 9%, not necessarily the inclusive growth as Manmohan Singh and Planning Commission talks about it. And in that context, when I raised the question, they said India is still a kind of a closed economy. And when I probed that and I mentioned to them, India is no longer a closed economy except for probably insurance sector, maybe financial sector also to some extent. Other sectors are pretty well opened. But people still have an impression here that India is a closed economy. And is mainly coming from the restrictions on increasing the foreign investment in insurance sector and the financial sector and retail. Would you like to comment on that for the purpose of, changing that image for the context of attracting more FDI to India?
I think on any issue, perceptions can vary, and perceptions also can be related to the objectives, if I may put it that way. First, let's accept the facts. India, in the G20, the lowest per capita income is that of India. There are more poor people in India than perhaps most of the rest of the world almost. So we have to accept whatever our achievements, whatever our reform, poverty is the biggest issue. And in fact, when I was appointed as the ED fund, the board, when they said that you are going 1 billion people and you have to manage the growth and stability, I said, no, the main issue is how do we make our policies relevant to poor people? Now, one view is that allow the growth, and then with the growth, the poverty will be eliminated. Possible. Equally possible. There's a growth, and there are a lot of poor people who don't see much happening to them, and then they can disrupt the society to an extent that there will be no growth for the next one generation. So the issue is that real life depends on societies. Finally, for some of us like us, world is getting globalized. But for most people, the life is local. And if I may quote Dr. Mervyn King, who said, banks are global in life, but they are national in death. This is what he said. So ultimately, this government which is responsible for its welfare. It may be wrong, it may be right, that's a different judgment. And yes, people believe that if you open insurance sector, poverty will be reduced. Possible. But I think bringing a more drinking water, not that they are mutually exclusive, but if the public policy is looking at the priorities, then you have to see the extent of the relationship and the quality of risk. How does it add? Yes, so there are a variety of situations. It will be very simplistic. Having recognized the problem, to say that growth at any cost and opening up, and not the empirical evidence. If I may just put it this way, there are two ways. You have empirical evidence, you have got counterfactual. The empirical evidence is that the two countries, and if you remove the poverty reduction in these two countries, there has not been much of poverty reduction in the developing world. The whole of developing world. Most of it, whether it's Eastern Europe or Africa or Latin America, which believed in enthusiastic globalization. The two countries which have been calibrated, managing their economies, have produced higher growth. You may say it will still be higher. But if you look at the capital output ratios, normal requirements of technology, productivity, etc. So I think we should be careful. There are different opinions are possible, but we should be careful in looking at both the empirical evidence and the type of social and economic factors which are involved in in decision making. And in fact, I would say that we can see some of the developed countries how open their financial sector is, including the opening for banking. There are many developed economies, but it may be different. It may be different, I don't want to quote, but anybody who looks at it. So opening is not an end in itself. Secondly, opening is not practiced as universally as it is proclaimed. But it is important. In the ultimate analysis, as I always tell people who try to be protectionist, many of my leftist friends, I said, look, if you want to have exciting cricket match, it can't be only Ranji Trophy. It has to be test cricket in the final analysis. It has to be global cricket, otherwise there's no excitement. And with the result now, we have brought even foreign people to play on our wickets to make cricket attractive. So I said, what applies to cricket has to apply to the economy. As simple as that. Thank you.
Yes.
My question is about quantitative easing. Could you talk a little bit about how you see the theory of quantitative easing, as well as the practice of quantitative easing, both in India as well as in other countries that you have studied?
Again, I'll try to be very general, not because I want to be diplomatic, but simply because I don't have real depth of knowledge in that. We didn't have that type of quantitative easing, but as far as the Indian situation is concerned, when the crisis hit, India didn't have the financial, there was some disruption, but that was marginal. It could be revived. And the financial institutions were by and large strong. There were two non-banking financial companies and mutual funds. They had a problem. And most important, the Reserve Bank opened a window. And that window was not providing only liquidity support. No solvency risk. The solvency risk have to be taken by the bank which has to assess, or the government which wants to do that. So that's one. But actually, in many of these cases, assurance of liquidity serves the purpose half the time. If it is a real liquidity problem. If it is a solvency problem, it won't solve the problem. So the best test of whether it is liquidity or solvency is assure huge liquidity. If the liquidity is not absorbed, if the problem has been solved, then you withdraw the excess liquidity. And that's what exactly the Reserve Bank of India has done. They have put in the liquidity. I think I don't know the exact numbers, but it's less than 50%. Was the total liquidity absorbed, but the rest, the Reserve Bank had the mechanisms to take it back. So it took back the money, injected the money, assured the money, injected the money, and every day they take the money back at a slightly lower interest rate so that it was able to calibrate. So if you say that quantitative easing as an instrument, as an ideological instrument, I won't say so, but in Japan they did the quantitative easing. But again, the quantitative easing, there's another problem, in my view, at least for countries like India. How does the quantitative easing affect the domestic savings? If it hurts, is it good for the country? Is it good for the economy? Apart from all the expectations, etc. Fundamentally, we get into that type of problem. So you could get into problems if you do too much of quantitative easing for too long.
Dr. Reddy, this might be an unfair question, but I wanted to get your thoughts on what the U.S. Federal Reserve is pursuing right now. Clearly, U.S. has got a problem that is similar to the emerging market in the sense that we are trying to solve a problem by printing money at this particular point. So, do you have a view on the policies that's been pursued so far, and if you look ahead? Do you see this having a happy ending or a sad ending? And I wanted to get your thoughts as a academic, so you can actually you don't have to be diplomatic.
No, I don't have to be diplomatic. You're really asking my opinion about the future. Generally, in India, we are very strong in astrology, and my particular province is super in astrology. But even so, I wouldn't venture, both with regard to because it's a very complex situation. And very simply stated, every short-term action taken to reduce the impact of the crisis adds to the original problem. And that's a trade-off. That's a trade-off. So if you extend that logic in a philosophical sense, the more you do for quick recovery, the more you may have problems later. So whether it is more, whether it is quick, only God knows. But this is only a philosophical statement one can make. Thank you.
Yes, I have the back.
Dr. Reddy, thank you very much for your enlightening lecture. I have a question on one of the topics you brought up, which is, for example, if you take infrastructure investment in India, there is obviously, let's say, a bottleneck. Everybody understands that. And there is a lot of emphasis on removing that bottleneck, improving the efficiency, and improving the GDP in general. But again, as you said, there is roughly $500 million investment required as projected. And looking at that from a current account angle, where you talked about if you have $500 million investment coming in, that would create problem in terms of current account deficit. It is very similar even in the stock market. If there's a capital foreign direct investment coming in terms of 10, 15, $20 billion, it kind of creates a bubble. So how do you manage this conundrum, I would say, and what are the options to alleviate that? Thank you.
Very simply stated, at a micro level, most of infrastructure does not require foreign currency. Roads, quite a bit of ports. So first, let's be clear. So we are really talking of macro. Second, currently, there is no problem of macro problem. You got excess rupee liquidity. You got excess dollar liquidity. With the result, you are adding to reserves. There's no problem with dollars. There's no problem with foreign currency. There's no problem with rupees. There's no problem of a policy and an implementation. It's not a financing problem. It's a policy problem. So you have to make things happen. There's no resource constraint. Thirdly, there is still a headroom. So it is not that there is no money. That's my limited point. Your current account deficit is 1%. So you've got a headroom of another 2% of current account deficit. Year before last, the surplus on capital account in 2007 was 9% of GDP. Excess capital flows. Almost all countries it was 2%, even the height 3%. So this is the problem. So if there is absorption capacity, it is fine. Now, the question is, you can say increase the absorption capacity. That's where I come into got this 400 billion CAD. You see, the absorption capacity should be increased. I agree. But the absorption capacity can be increased to the extent that there is a reasonably assured level of flows over the medium term. If the capital flows are volatile, can the absorption capacity be volatile? Is it possible for any policy maker to have an absorption capacity which will go up and down depending on the money coming in and going out? That is what is said. Basically, you must get the macro right. And as long as macro is there, there's sufficient headroom in terms of financial resources, in terms of financial intermediation. And in any case, except to some extent USA and UK, almost all parts of the world, it was essentially public investment or a banking sector investment. What happened in Europe? What happened in China? What happened in Asia? The bond markets financing infrastructure is more or less a sort of an Anglo-Saxon phenomena rather than a global phenomena. It may be good, it may be bad, that's different. So we have to take a more historical, a more global, a more macro view also when looking at it. I'm not excluding anything, it's important. But to think that will solve, and more of it will solve it quicker or more, I mean, that is where we have to take a realistic view.
Dr. Reddy, actually, I'll just ask you if I can. One thing which we see in some of universities, and I see it with my friends who teach in India, is that bright young people from, here in India, the IITs, IIMs, very few want to join the public sector, right? Do you see this problem of hemorrhaging of talent, which the public sector in India 30 years ago was able to attract? Now, when you look at the various regulatory institutions, you look at the Reserve Bank, is the problem of being able to attract talent, does that pose any serious long-term issues, or it's really, or there is enough of a depth of a talent pool out there?
I'll make my own personal view is it's not so much, I mean, even now about 20%, 15 to 20% of people who join the civil service are from IITs. In any case, they take only a few hundred, so if you take the proportion. Maybe compared to earlier times, it's not. But it's not more than the talent. My feeling is, and I want to be honest, the private sector has not realized the importance of public sector. Private sector, I must admit, I must say this now, every day in and day out, we find private sector complaining about corruption, about bureaucratic delays. Are there suggestions, or are they contributing to this? In their own ways, in non-transparent ways. The limited, in fact, Professor Avinash Dixit gave a talk, and in a number of my speeches I said, the private sector should be funding mechanisms by which the public sector improves its efficiency. By undermining public sector, you are not adding. India can never, never become a middle-income country unless the public sector, including regulatory system, improves its efficiency. And it's not a question of remuneration alone. It's not a question of remuneration, it's an attitude. And I can be very frank, and I tell my children that no, you see, we were prepared to join the civil service, not for money, but for respect. Now, you don't get money, you don't get respect, you get only abuse. Why don't you be the other side? Make more money and give abuses. Why do you... I mean, it doesn't make sense. So I think, to be very honest, the solution is not material, but having a, I'm not joking, you can see the editorials in the papers. Even when you follow the law, there is a law laid down by the parliament, you follow the law, and you are told that you are bureaucratic if it doesn't suit somebody. So I think the whole culture of undermining public service, undermining public enterprise is wrong. And incidentally, I must also share this with you. When I was in charge of a search committee for something, we tried to get somebody, and it was very difficult. We offered to private sector, we offered to ex-government sector. Then finally the finance minister asked, what is this? Why can't you get? You get only bureaucrats. So I said, sir, this is the problem, that they can make money and abuse, whereas these people don't get money and they have to receive the abuses. How are they going to do? Then he said, I say, then why are you here working in this sector, in the public service? So I said, sir, addiction, addiction, and addiction.
Thank you so much to Dr. Reddy. I think that was your sense of humor. Given that you have worked with the Indian government, I think you said since 1964, and I think you needed a lot of that to survive so well. Thank you again all for joining us.